let's just take a quick review of the day for any of those who haven't been in the markets for the entirety of the session. So just having a look at equity markets, just jump back into the S&P. We have seen a little bit of volatility around the open, very briefly touching on fresh highs. 57.75 now, printing as your all-time high in the S&P, but really this being an asset that's not being the most exciting of sorts, given the fairly tight nature of the range it's been trading in. If we start certainly looking at this on a longer time frame, it's just been ever so quiet in the equity market. So far on the intraday move, we've kind of had the pivot level providing a degree of support, but going out for the rest of the session, I can't imagine that this market's going to really do a great deal unless something unexpected happened. Elsewhere, gold as well hasn't done too much. It remains marginally positive, but again, not really too much movement. Elsewhere though, some of the other assets seeing a bit of better movement. Oil's been one, and WTI crude, after rising for those reasons which we were covering in the briefing this morning, whether it be the rig count going down, an explosion at a key Louisiana oil rig in the US, you got Trump still talking about Iranian potential sanctions if Iran don't comply in the next 60 days, Congress likely to further push forward the issue. So a lot going on, and that obviously Iraq and the Kirkuk-Ceyhan pipeline situation was one of the key catalysts for the rise. Now, on the pullback, you've had a little bit of a recovering dollar. You did have some good data. We'll look at that in a second. The New York Empire Manufacturing Index. But you've also had the Iraqi Oil Ministry earlier this afternoon say it will be a very short time before it recaptures the Kirkuk oil field and production does restart. So, having a look at oil at the moment and where we trade, I guess this level we're at the moment, which was the previous highs that we printed back in the end really of last week, we've just gone below there now, this last little push down. So probably a level, if we continue this trend, 51.50, we'll just be keeping an eye on that kind of point of resistance for much of what would have been Friday afternoon and evening into the US session. And then you've got pivot if we continue that move to the downside. So kind of a seesaw day, initially supported, decent move that's seen since the opening of reopening of electronic trade. Managed to get about $1 out of the price action before then, a little bit of profit taking from the most elevated levels. Maybe just a little bit of stabilization with that pricing around the Kirkuk situation developing. Elsewhere, bunds have remained fairly well bid. And if you look at bunds, really, over the course of the last couple of sessions, you've seen a pretty decent move on the upside. Now, a couple of things to contemplate here. One was at the end of last week, we had the Bloomberg sources suggestive that, yes, QE program going into next year likely be extended by 9, not 6 months, but the size of the cut being more aggressive, from 60 to 30 billion rather than 40 that was kind of factored in a few months back. And so, you know, kind of the gradual unwind, if you like, being relatively slow of QE. Then you've obviously got the political risk where Catalonia, we heard this morning, still ongoing. I won't be really expecting too much on that until we get through the middle part of the week, because the new deadline that's been put forward by the Spanish government is that by Thursday they want an official confirmation from the Catalan officials. What are you doing? Are you going to formally push for independence or not? And then we'll get, at the end of the week, likelihood, the next kind of turn in that topic, i.e. the response officially from Catalan, then what will the government do? But certainly a bit of risk there. The Austrian situation, the German situations we discussed this morning, you've got Brexit, so there's a lot of re-emergence of EU political uncertainty, and if anything, this, you would say, starts to translate into more potential difficulties for the ECB to pursue any type of kind of faster speed tightening, and so bunds have been supported. On the flip side, the euro's traded a little heavy, although it's recovered from its lowest level, which was down at this kind of 118.19 level. Prices, generally speaking, trended low ever since the overnight session. So again, some of this political risk just helping take back some of the pop that was seen on Friday when the dollar moved on the back of the CPI and the retail sales report, but the CPI predominantly. Okay, having a look at cable, we have seen a pretty quick move earlier in the session. Now this candlestick actually, if you put it down to second charts, or a minute I should say, it was a pretty fast move down on the Brexit situation. Talk of a breakdown of the negotiations rather than just a stalemate, and so pound popped lower. This came amid, or a few minutes after, the US Empire manufacturing number came out, and that came out considerably higher than expected. In fact, it was the highest level since September of 2014. The market was anticipating a 20 print, we got a 30 spot too, and that definitely puts us on a high for the 12-month period. But if we were looking at a 10-year max, you can see here that was that high point I've just mentioned. If we were any higher than this, then really you go back all the way to 2009 and then all-time highs for this measure. And so particularly strong data, little bit of dollar strength, then the Brexit negative comment hit, and we saw at trigger technically the low that was seen from the European Open this morning, and consequently we ran straight down to the low that was seen on Friday morning. Which was close proximity to that S1. Again, as I mentioned at the time, the bounce I felt was, well, the speed of the fall was initiated by, yes, those aforementioned reasons, but also some stops being hit on the back of that low being broken. So in context, the comment that was made, I feel, was just more negotiation, kind of bluffing, if you like. Theresa May, as we know, is back in Brussels as of right now, and she's there trying to meet with other EU officials as well as EU partners to get them on side ahead of the EU meeting, which is due to commence at the end of the week on Thursday. So that was the run lower. We have recovered since, which I think makes a degree of sense, because I didn't think that comment was too much after the initial kind of volatility that was seen. And if anything, we've consolidated back within this range that we were in, and around a 133 handle in cable. Cable really as well, there's a lot to play for this week, as we discussed this morning. So I think as well, investors are a little reticent to really take the move any further, and quite happy to have the price sit at a 133 handle. Why is that? Well, if we flick over to tomorrow, this is a really crucial day, as I discussed in the briefing, because UK CPI is expected to hit 3%. And if you remember, if we put this in a bit of context here, we've not hit 3% so far this year. Now, this is the CPI chart that I'm looking at from when Brexit happened, so the summer of 2016. This is the gradual ramp up then of inflation that we saw at the back end of last year into this year, in Q1 in particular. We hit the peak in May. We dipped momentarily. We've come back to 2.9% in the August reading, but for September we're now expecting 3%. Obviously that's a percent away from the Bank of England's target, initiating then the governor to have to report back to the Chancellor of failing to hit that target. We start looking on a 10-year inflation picture in the UK, you can see as we start to get to 3%, really that puts us back at levels not seen since 2012. And so this is the big kind of decision that the Bank of England's MPC are going to have to make, is about where is this inflationary trend going, i.e. looking at the speed of which it's risen, where is the top of this inflationary kind of re-emergence. Obviously it comes in a fairly negative backdrop where wages are being far outpriced by the or far out driven, if you like, by the speed of which prices are rising, making it a more difficult situation for the UK consumer, and therefore net ability to remain confident and spend and so on and so forth, hence the negative implications for the economy. So tomorrow's data really is important, because if that inflationary reading, I feel, is 3.1 or more, then I think it becomes not a decision but a must that the Bank of England are going to have to hike in case of inflation starting to run away further. And so this is going to be very important in the short term, irrespective of the Brexit talks that are ongoing and the EU meeting. In the short term, intraday, certainly that will be the big price driver. So CPI, core CPI and the RPI numbers, PPI also coming out, input, output and the core readings. That'll be all at 9:30. Later on, you've got the German ZEW economic sentiment. So, as I always say, every month after IFO, this is probably the second most important German reading in terms of forward-looking sentiment surveys, this being of economists and analysts for their 6-month horizon. Given the context then of political uncertainty, ECB tightening, but some generally strong European growth, it'll be interesting to see how economists are feeling going in forward into 2018 period in Germany. You've also got the inflation, but this is the final reading for September coming out of the Eurozone. Going further on, you then go into the US afternoon. You've got industrial production, cap utilization, some housing market data and the TICS numbers. So probably IP will be the one of some interest, but really it's going to be of a single headline event, probably the CPI data, which will likely create the most market volatility tomorrow's session. All right, going to leave it at that. So hope you've had a good day, and I wish you a pleasant evening, and we'll be back on the mic to get you up to speed tomorrow morning first thing. All right, thank you very much.